All right. Today is Wednesday, January 12th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. We're going to talk about everything from the reaction of the dollar to the bond market to the stock market to the CPI. We're going to try to decode everything for you. But let's start with this. In focus tonight, the highest inflation in 40 years, and it doesn't appear that it's slowing down at all. U.S. inflation reaches the fastest pace since 1982. The December Consumer Price Index was up 7% year over year. This is not good, folks. This is absolutely alarming. And if you watch the commodities response today, from crude oil popping higher, to metals, to grains, to natural gas is up over 13% today alone. The best start of the year for natural gas in 30 years. So this inflation is just going to get bigger and bigger and bigger. And let me say this, I'm the king of bears. I'm an inflation hawk. And even I was anticipating a bigger dent to inflation because we know that energy prices went down in December. So I was anticipating a larger dent to inflation. Well, guess what? Inflation is up year over year, up month over month. Yes, we got a dent, a small one, month over month from energy prices and meat prices down about 2% apiece. But that's about it. The rest, even month over month, we're seeing price increases across the board, be it medical care, be it housing, be it goods, be it services, be it food, be it cars, everything is moving higher. And the inflation in used cars specifically is absolutely stunning. No stop in sight here, surging out of control. And the inflation in used cars prices is extremely important, because it offers a clear illustration of what's going on in the inflation dynamic that we have right now. Some would say that the inflation in used cars prices will be resolved by resolving the supply chain problems and producing more new cars to the market. In theory, this is correct. The problem is, it's going to take a long time to resolve the chip shortage, to increase the supply chain, to hire new employees, to open new factories and assembly lines. All of that's going to cost more. By the time you produce these new cars, they're gonna cost more. And we cannot wait and take the risk of inflation increasing even higher, morphing to hyperinflation, while we wait for the supply to catch up. And therefore, perhaps now you understand why the Fed is becoming more hawkish and moving toward crushing demand. Because this is the only option available for now. Inflation in used cars prices is the best evidence against all inflation skeptics who've been saying that inflation is transitory. And the best evidence for that, look at used cars. We have inflation, but once the new fresh supply hits the market, these prices will go down. Well, guess what? We have new cars hitting the market right now. Not enough, but still, used cars prices continue to move higher. One of the biggest inflation skeptics is ARK Invest fund manager Cathie Wood, aka Tesla witch Cathie Wood. She said yesterday that we will see a bloodbath in the market. What is she talking about? She said that she would not be surprised to see a bloodbath in the used car market, quote unquote, with valuations tumbling in the coming year into 2023 as prices that have surged because supply chain bottlenecks and a pop in demand recede. Are you talking about the bloodbath as in the bloodbath in ARK Invest ETFs, Mrs. Woods, or Wood, whatever your name is? And guess what? Mrs. Wood is wrong because used cars prices are moving higher, even month over month. Unbelievable. And it's not just used cars prices, by the way. It's everything. It's goods, it's services, it's gasoline, everything you use, everything you consume, food, everything is moving higher. Mr. Powell says, I should act right now to prevent inflation from being entrenched in the economy. It is already beyond entrenched, Mr. Powell. You're already too late to the game, and you want to wait till March before you start acting. And remember this? Empty shelves? Hashtag empty shelves Joe? Well, that's making a comeback because empty shelves are returning. And Melissa Ripko, she attributed this to sick employees' supply chain delays colliding. And I say, how about empty shelves due to the cocaine from the Federal Reserve? That's all there is. We had sick employees before, we had quarantining before, we had reopenings and lockdowns before, and yet still, inflation continues to move higher. We continue to see these scenes more frequently. You can talk about the supply all you want, but how come nobody's talking about the demand side? The trillions in stimmies and loose money that fueled unprecedented level of demand. There is no supply chain in the world that can cope with this kind of level of demand. Empty shelves across the country. From South Carolina, fruits, nowhere to be found. Chicken, nowhere to be found. Beef, nowhere to be found, be it in South Carolina, be it in Washington State, or anywhere between. Bread, nowhere to be found in certain stores, even in Colorado. Ice cream, nowhere to be found. Who the hell wants to eat ice cream in Colorado? But anyhow, to each his own, whatever floats your boat. And here's a sign in one of the grocery stores with the empty shelves. It says, please bear, as in bear the animal. As of us, bears. Please bear with us. We're experiencing high demand. High demand. Not a shortage of supply. Not, the ships over at the LA port were waiting for the goods. No. We're experiencing zombies all over the place with the highest level of demand possible. Part of it is the loose money all over the place, and part of it consumers chasing inflation. Consumers wanting to consume now before prices get even higher than they already are. And when I say that this is the superstorm of inflation, because all factors are colliding, be it supply, be it demand, be it the reckless monetary policy, be it labor strikes, be it weather phenomenons, and here's one of them. We have a labor strike in Kroger. Over 80 stores are impacted right now. And you and I know from our anecdotal evidence that people are getting hit with the virus, the Pokemon. Whether they have symptoms or not, that doesn't matter. The moment you have a positive test, you're going to have to stay at home. And this is impacting the flow of goods, the supply chain, and commerce across the country, pushing inflation higher and higher and higher. You know what else is in shortage? How about respect? This is at least according to truckers. The truck industry says we have a shortage of trucks and we have a shortage of truckers, but we also have a shortage of respect. How about you show us some damn respect? And we talked about the struggles of truckers and the trucking industry in general in a past video where I shared my personal experience being a truck driver before. And yes, it's not just the lack of respect, being underpaid, overworked, lots of hazards, lots of health problems. It's just not worth it anymore. Whether we like it or not, salaries and pay for truckers will move higher from this point on, regardless of the inflation dynamic. Because the industry realized that to retain truckers, you gotta pay them more. This is yet another extra input cost for corporations, for warehouses, for stores that they're gonna have to incur. Whether we have inflation or not, the game has changed, the mentality has changed, and truckers are not gonna do the job unless, number one, they are desperate, and they're not gonna be desperate for income unless we have a recession. Number two, they're only gonna get back to the job if they are well compensated. So this is one cost that's going to continue to move higher. No doubt about it, which means that inflation is going to continue to move higher. It's going to be really sticky for the Fed to tackle, and they're already behind the curve. Look at where inflation was at the beginning of the pandemic versus where we are right now. The year-over-year inflation on February 2020 versus December 2021. Gasoline prices not even close. We have over 50% inflation in gasoline prices, energy, natural gas, vehicles, apparel, food at home, food away from home, food in general, electricity, shelter, everything is moving higher. And by the way, the CPI grossly underestimates shelter inflation. Ask anybody in the country. Coast to coast, rents are surging out of whack. Wait till you renew your lease and you get hit with a 30, even 40, in certain instances, 100% increase in rent. And the CPI says, shelter inflation is about 4% year over year. Give me a break. On top of that, the Fed today released their beige book, and they're seeing solid growth, quote unquote, not in the economy. They're seeing solid growth in prices across all districts. When we look at inflation across different cities in America, and this is the watered down version, of course, this is according to the CPI. Atlanta, almost 10% inflation. Baltimore, 8% inflation. Detroit, 7%. LA, almost 7%. Miami, 7%. Phoenix, almost 10%. I'd like to see San Diego. That has to be over 10%. And once again, this is the watered down version of inflation, courtesy of the cooks, of course. And here's another bombshell. Most Americans saw their real wages drop in 2021, except for hotel and restaurant employees. Every single sector, utilities, manufacturing, construction, retail, education, doesn't matter which one you work at. Your wages went down when you factor in inflation. With the exception of leisure and hospitality workers, they're getting paid more because of the need. But these workers will be the first to be shown the door when the economy starts to turn sour. And I say this, if shelter cost was calculated correctly in the CPI, it would show workers getting a 10% plus pay cut. Again, is inflation good for the poor and middle class? Average workers? Of course not. And here's yet another alarming piece of data. The median household income has been rising steadily since 2011. Of course, it stalled in later years, but look at what's going on here. If inflation continues to rise, it will erase a decade worth of gains in household income. Once again, if inflation continues to run unchecked, soon enough, it will erase a decade worth of gains in household income. And you wonder why the administration and the Federal Reserve are panicking right now. But rest assured, President Joe Biden says his administration is making progress, quote unquote, in battling inflation, pointing to slower gains last month in energy and food prices. Mr. Biden, yes, meats went down, but that's going to recover. Energy went down, and that is already recovered. Look at the chart of the WTI or Brent, natural gas, they're all recovering. And other food items, the majority of food items were actually up year over year and month over month. This is a massive headache for this administration right now. They are in panic mode, red alert at the White House, because if we head to the election season in 2022 in a few months, with this kind of inflation going on, we will see the biggest red tsunami since the Reagan era. And I said before in my Twitter feed, in this program before, that the biggest political enemy for Joe Biden is Jerome Powell. What did Joe Biden do? He renominated his biggest enemy, Jerome Powell. Absolute delusion. Talk about shooting yourself in the foot, because you and I know inflation is always a monetary phenomenon. We're seeing inflation across the globe. In the UK, in Germany, in Canada, in Mexico, in Brazil, in the Middle East, in Asia, all over the place. And Joe Biden is not the president of all of these countries. We're seeing central banks, for example, the Central Bank of Russia, hiking interest rates 10 times. Yet inflation continues to move higher in Russia. Why? Because the source of inflation is always the Federal Reserve, the central bank of the world. When America sneezes, you're all going to catch AIDS. Doesn't matter what your central bank is going to do. It's all about the Federal Reserve. Take, for example, pasta prices. In Italy, pasta prices are surging out of whack in Italy. Whether we look at pasta, olive oil, bread, tomatoes, mozzarella, all moving higher. But notice this. Pasta and bread are tied to wheat commodities, which are widely traded. Commodities are being impacted by the monetary inflation. When you have all of that cash chasing few assets. And these assets happen to be commodities, including wheat, and therefore pushing wheat futures higher. So it doesn't matter if Italy has supply of wheat or not, or we have a shortage of supply from Canada, or even a surplus of supply. You're going to see futures moving accordingly to these pieces of news, and then they're going to buy the dip anyways, because this is what happens under a monetary inflation environment. On the other hand, look at tomatoes. Tomatoes are not widely traded. You can have certain futures here and there, but they're not widely traded, and therefore they live within the normal cycle of supply and demand. Supply goes higher, prices go down. Supply goes down for whatever reason, be it weather or otherwise, and prices go higher. But it is within a range, a defined range within a normal range. And this used to be how commodities traded before the loose money policy started. You have good news about the weather, about crops, futures go down. You have bad news, futures go up. But are we acting as COVID all of a sudden destroyed the crops of coffee, wheat, blueberries, canola, oats, soybeans all over the world? All of these crops got damaged by COVID? This is nonsense, folks. Why do we continue to see buying of the dip in all of these commodities? There's one explanation here. Inflation is always a monetary phenomenon, and therefore you're seeing a steady rise in the prices of pasta and bread because they're tied to wheat futures, and wheat futures are moving higher. Today we got some bad news for wheat futures. Wheat drops with U.S. forecasting bigger global reserves. Watch how fast they're going to buy the dip in wheat futures. So it doesn't matter whether we have supply or not. They're going to buy the dip over and over and over again. We saw it with soybeans. We saw it with coffee. We saw it with corn. We see a surplus of supply. Prices go down. They pick them up right away. Look at Poland, for example. Inflation is surging higher. out of control in the country of Poland. Did Poland also run out of all of these crops and therefore inflation is moving higher? How about Germany? How about China? They're all facing the same problem. Either we have some biblical event that I'm not aware of, where crops got destroyed across the globe, or we have another thing going on here, beside the supply and demand dynamic, which is monetary inflation. Even Japan, the emperor of deflation, Japan is now facing the highest inflation in over a decade, and inflation expectations among households in Japan are moving to the highest since 2008. The headline reads, "As costs soar, some Japanese companies do the unthinkable, raise prices." Even in Japan, it's happening. We can go back and forth. You could say, well, look at the Japanese. They continue to print. How come they're not having monetary inflation? And the answer to this question is, simply put, the difference in consumer behavior between the American and Japanese consumer. We can do a whole video why Japan remains in deflation. But if you're looking for good news here on the inflation front, perhaps you want to look at China, because inflation in China went down in December. And now the Bank of China is thinking about rate cuts. Well, guess what's going to happen here? You cut rates, inflation is going to come back again, because why did inflation go down in China? The answer is the Pokemon variant. They have draconian lockdowns there, zero case policies, and this will slow down inflation on a transitory basis, of course. And then it's going to come back again, specifically if you're going to use the opportunity to cut rates. Is China about to be the next Turkey? Look at what Erdogan is doing. Cutting rates to combat inflation. And guess what's going on over there? Inflation is surging out of whack, perhaps the highest inflation in the world, along with Argentina, Brazil, but Turkey is pretty much at the top. So that is a failed policy. We already know that. Are the Chinese about to begin this illogical response of cutting rates amid surging inflation? Because that would be a disaster scenario. And by the way, until the Federal Reserve starts to aggressively raise interest rates and tighten the monetary policy, the Chinese will face higher inflation because they buy commodities on the global market. The majority of these commodities are dollarized. You're going to buy soybeans, you got to pay the futures price. You want to buy corn, meats, lumber, doesn't matter. You gotta pay the same price that is trading in the market right now. And these prices are all inflated. And it works both ways. We are contributing to higher inflation in China. China is now contributing to higher inflation here. Take, for example, this headline. Every week, in COVID-related delay at China's Ningbo container port could hit $4 billion worth of trade, much of which is bound for the U.S. A lot of folks say if we can dock the ships, if we can unload the ships stuck at the ports, we will defeat the crisis, the supply chain crisis. But these ships continue to come. We still have pent-up demand. We still have ships waiting in China, waiting for the green light to head all the way to the United States, full of goods. Why are we seeing this phenomenon? Once again, out of control demand. And this out of control demand is fueled by the Fed's easy money policy. It's not just us, the consumer, hoarding goods. It's also corporations. They want to buy now. They want to buy the goods now before prices go higher. Everybody's chasing inflation here, and it's just going to continue to build on and on and on until we have a massive shock, a massive jolt to the system. And this will only happen by the Fed being aggressive in tightening the monetary policy. Speaking of the Fed, have you noticed how all of a sudden they're all becoming hawks? All of these zombies are becoming hawks. Take, for example, Cleveland Fed President Mister, what a piece of work. She now sees 3 rate hikes this year. Let's go back to October 22nd of last year when Loretta Mister was interviewed by CNBC. Let's hear what she said about raising interest rates.
So we know that most all of you agree that tapering is a go at the next meeting. How are you thinking right now about interest rate hikes and when that may happen?
Well, I think, if you look at what's happening in the economy, there are those things going on the supply side and the demand side. I don't think that interest rate, hikes are coming anytime soon because I don't think we'll reach our goals, which are maximum employment and, inflation at and above 2% for some time. So I think we're going to basically think about the decision, coming up, which is about the asset purchases, right? And then as those wind down, we'll have time to assess where the economy is, what's happening with inflation, what's happening with employment, so that we can see the progress towards our goals. So that's a longer term. That's not a current, decision that has to be made. We're going to look at that as we go forward. And you saw that in the last set of economic projections that the FOMC participants put out. right? The thought about raising interest rates is not a near-term consideration at all.
And yet inflation is running pretty hotter than most people expected and lasting longer than most people, including you guys at the Fed, expected. Have you stopped using the transitory word, or have you changed the way you've thought about how long and how persistent?
Transitory, so funny. We got it wrong. So funny. What a bunch of incompetent Looney Tunes. All of them. And now Mr. says she wants to shrink the balance sheet fast, but she also doesn't want to damage the stock market. Well, you can't have it both ways. You can't have your cake and eat it too. This is a junkie stock market, hooked on drugs, on coke, for over a decade now. Once you take the drug away, the market will suffer a withdrawal. There is no way out here. And by the way, here's a thought. And please do not share this with Jerome Powell. I was thinking, what if the Fed started to raise interest rates last year, but kept the assets purchasing programs, meaning buying bonds? Maybe that would have tackled inflation down, but kept the stock market higher. Who knows? But here's another Fed zombie from Atlanta, Boystick. He's also calling for a liftoff in the policy and raising interest rates in March and reducing the balance sheet fairly soon, quote unquote, according to Mr. Boystick. Another dove who just became a hawk. How about this one? Kansas City, Esther George. She's also calling for a faster sell-off of their balance sheet. They're all becoming hawkish right now. Do you really think that this is a coincidence, by the way? Or are these just orders that come from above? Because you and I know Jerome Powell, at the end of the day, is just the button man. He's just executing orders. From who? From those who are above. Who's above? I can't talk about it right now. I'd like to stay alive. But it all revolves around the satanic cult over at Davos and the World Economic Forum. I think you know what I'm talking about here. They had an agenda, and the agenda was inflate everything. And now the agenda is deflate everything on the top of the heads of the little morons, you and I. And then we have St. Louis Fed President Bullard, who's been slightly hawkish for a while now. This is not news to us. We already knew that Bullard, since he's not a voting member, he can speak freely and say whatever he wants. And today, Mr. Bullard upped the ante by saying that he now thinks 4 interest rates increases might be needed this year. And by the way, Bullard is now a voting member, along with Mr. By the way. She was not last year. Both of them were not. Now they are. And lastly, how about this headline? In the morning, stocks went higher despite the hotter CPI reading. Stocks rise as Wall Street shakes off red-hot inflation report. They're shaking it off right now, and soon enough, all of that shaking will cause their pants to fall down. Anyhow, let's move on to cover the market information, starting with the market performance. And here we go! The Dow Industrial Average closed in the green, gaining 38.30 points, or 0.11%. The Nasdaq closing in the green by 34.94 points, or a gain of 0.23%. The S&P 500 also closing in the green by 13.28 points, or a gain of 0.28%. The sector's performance, what's going on here? Coming up at number 1 and capturing the gold medal, materials. At number 2 for the silver, energy. Number 3 for the bronze, cyclicals. On the other hand, the laggard of the day is healthcare. All in all, a good performance for the market, yet the action was led by the inflationary trade. We're talking about materials, we're talking about energy, cyclicals, all moving higher in response to a higher CPI. So some would say and read the action today as, oh, the market is shaking it off. It's not shaking it off. The market is trading accordingly, and we will discuss more in the heat map and the charts analysis. But what about the advance to decline ratios? NYSE, 48% advancing versus 48% declining. The Nasdaq, 36% advancing versus 60% declining. Once again, the Nasdaq is being floated by the big caps. Moving on to futures. What's going on here? The dollar is down, and you could attribute that to the Australian dollar or other currencies firming up, but the action was clear. Looking at the charts, the dollar started to flush down once we got the CPI reading. And this is the mystery today. Why is the dollar down? Meanwhile, bonds did not move, yields did not drop down. Matter of fact, they're moving higher right now. The 2-year finished in the green. The stock market pretty much flat. We have mixed messages here because the dollar on one hand is saying that perhaps inflation is peaking. This is not the same reaction by the bond market or the stock market, and even commodities. Commodities are saying that inflation will continue to build on. Just look at what happened today. Energy prices popped higher, be it the WTI, Brent, gasoline, heating oil, all moved higher, gains of of over 1% apiece. But the stunning move today was in natural gas, a massive pop higher. And I already predicted that, by the way. I told you that natural gas will push higher again. It doesn't matter which commodity you're looking at. It doesn't matter what piece of news you're hearing. The weather, the crops, the supply, the demand. Under a monetary inflation, commodities prices will continue to move higher. Not all of them, but the majority. What about softs? We have another massive prop in lumber, gaining over 3.5% today alone. And soon enough, we're going to recapture the prior high. When everybody was panicking about lumber prices and the memes started to appear, we're getting back to that mania in lumber. And lumber serves as a cautionary tale that the dip in inflation is transitory, not inflation, until and unless the Fed starts tightening aggressively. We also have gains for coffee, cotton, and sugar. And perhaps sugar futures are bottoming right now. Keep an eye on sugar futures. Yet we have losses led by cocoa and OJ. On the other hand, what about metals? Gains across the board with exception of palladium, gold up, silver up, platinum up. But the party boy here is copper. Copper gaining over 3% today alone. And I have some news for you. Stick around. Meats, live and feeder cattle futures are down, while lean hogs gaining over 1.5% today. Grains, we have gains for soybeans across the board. Soybeans, soybean meal, soybean oil, all trading higher. While we have flattish activities for corn and rough rice, on the other hand, losses in wheat, oats, and canola futures. Here are some commodities news for you. Let's start by energy. The performance of energy was absolutely impressive last year. Energy commodity prices went higher by 59% in 2021, outperforming the S&P and the Nasdaq. When we talk about natural gas prices, one of the catalysts, the tailwinds here, is the massive storm in the East Coast, and this storm is moving down south. Look at this historic pop in electricity prices in New York, jumping to a 4-year high. The storm we're about to have will extend down all the way to Florida. Therefore, temperatures are dropping down and the demand for natural gas is moving higher. When we talk about natural gas, we cannot ignore the tensions between the US, Russia, and Europe being caught in the middle of that conflict. Look at the import terminals in the UK. Liquid natural gas shipments are surging higher. On the other hand, gas flows from Russian pipelines are dropping down sizably. And you gotta bear in mind that this is a wild card that could light up on fire really fast. And if it happens, you're not gonna see just disruptions in natural gas prices. You're gonna see it across all commodities, specifically energy commodities. You're gonna see it in the stock market. You're gonna see it across global economies. You're going to see it in the geopolitical arena. And this wild card is, what if Putin indeed invades Ukraine? We're talking right now, but there is little progress. We're seeing Russia moving military helicopters to the Ukrainian borders. As the talks with the US stagnate, we're seeing Russian troops performing drills with tanks and troops right across the Ukrainian border. This is not good, folks. If it happens, it will rattle the entire global economy. This inflation will get even worse, much worse. What about oil? What's going on with the demand for oil? We have data that the 4 top Asian consumers of oil, that is China, India, Japan, and South Korea, that demand remains intact for the first half of 2022. So the demand for crude oil remains hot. The supply is lagging demand by a little bit. You combine that with the monetary inflation that we're having and the tailwinds pushing energy prices higher, specifically oil in this case, remain intact. What about lumber? Lumber prices are moving higher again, and so are the scams. Thousands of dollars in lumber stolen in fake receipt scam. Somebody had fake receipts from Home Depot. They walk in the store and they collect lumber for free. Well, that is one way to defeat inflation. What about soybeans and metals? What's going on here? We have extreme weather in Brazil, one of the top producers of commodities across the globe. When we have dry weather like we had last year, a scarcity of rainfall, that in turn damaged soy crops, and therefore we saw a massive surge in soybean prices. Now we have another phenomenon where we have extreme rainfall. This is good for soybeans, and therefore you saw a dip yesterday and the last few days in soybeans futures. But guess what's going on right now? They're buying the dip in soybeans. On the other hand, the rainfall is damaging mines, and therefore we're seeing iron moving higher, copper moving higher. All of these metals produced in Brazil are moving higher due to the extreme weather phenomenons. This is what Powell does not understand. You're fighting on all fronts here, Mr. Powell. The supply, the demand, the coke, the weather, the labor shortage, the geopolitical tensions. Once again, the superstorm of inflation. And copper had another tailwind today, the shortage in supply, along with nickel, by the way, that is all moving copper and nickel higher. Lithium, similar story here. The demand is so high, the supply is here, but it's going to take a long time for the supply to catch up with the demand. And therefore, lithium prices also moving out of control. Moving on to the big casino, the options market. What's going on here? The hottest table by far is AbbVie, the ticker ABBV, with over 1 million contracts traded today. About 98% of those were calls. By now, you know the drill. This name is paying dividends tomorrow. I happen to own the name, and every time we see dividend-paying days, holders of the stock write covered calls with expectations that there are some holders of the stock who are just awaiting a dividend payment, and then they're going to dump the stock, and therefore that creates a dip. Yet I caution from betting against this stock because it pays a high dividend. It is a value name. It has a solid cash flow, and any dip in this name will be bought. In this environment, a giant company with solid cash flow and high dividend like AbbVie is the kind of name you want to be in right now. So any dip will be bought right away. And here it is at number 2, Apple. What's going on here? Almost 1 million contracts traded today. Notice that the volume is down across the board. Without the options mania, what's going to move the market higher? Out of these million contracts that traded today for Apple, about 68% of those were calls. And at number 3, Tesla, the souffle, with about 900,000 contracts, about 62% of those were calls. What about the unusual activities that took place in the options market today, starting with the ticker HTA? And this stands for the Health Trust of America. The name is trading pretty much at all-time highs. Somebody's betting for more gains to come here. They're opening a call spread. They're buying the 35 calls, and they're selling the 37.5 calls, all for the expiration date February 18th, with the expectations that the name could pop higher by more than 6.5% by then, but not more than 14%. They paid about $1 a piece for the 35 calls that they bought, and they received about 40 cents a piece from the 37.5 calls that they wrote. That reduced the entry cost all the way down to about 60 cents a piece. All in all, spending about $2 million. Next, we have the ticker SPY for the S&P 500. They're buying puts, the 390 puts for the expiration date, February 25, with the expectations that the SPY will drop down by more than 17% by then. They paid about 73 cents a piece to enter this trade, all in all spending about $2 million. What about the trade for the ticker FANG, FANG? No, this is not for the FANG that you're familiar with. This is for Diamondback Energy, one of the hottest names in the stock market right now. They're buying the 135 calls for the expiration date, March 18th, with the expectations that the name could pop higher by more than 8% by then. They paid about $6.50 a piece to enter this trade, and all in all spending about $8 million. What about the trade for the ticker XOP? This is the oil and energy gas ETF. They're buying upside calls here, the 125 calls for the expiration date March 18th, with the expectations that the name could pop higher by more than 14% by then. They paid about $3 a piece to enter this trade, all in all spending about $2.4 million. What about the trade for the ticker V for Visa? Beaten down, but perhaps we have a rebound here. Somebody's buying the 230 calls for the expiration date January 28th. With the expectations that the name could pop higher by more than 6.5% by then, and they paid about $1 a piece to enter this trade, all in all spending about $800,000. Lastly, what about the trade for the ticker QS QuantumScape? They're buying calls here, the 25 calls for the expiration date, February 25th, with the expectations that the name could pop higher by more than 19% by then. They paid about $1.30 a piece to enter this trade, all in all spending about $850,000. And by the way, this trade is among many trades that I saw bullish trades, all of them, for QuantumScape. So something is brewing here. I don't know what it is, but they're anticipating some good news by around February. Moving on to the heat map, what's going on here? Again, muted, mixed across the board. The high multiples are getting shot. We're talking about names like Trade Desk, CrowdStrike, the software names. We're talking about Zoom, Roku, Twilio, Dash, Carvana, all getting shot today. Yet the performance is mixed here. The big caps are working okay, with exception of Facebook, Apple, Amazon, but Microsoft, Google all gaining over 1% today. We have chips, Taiwan gaining over 2% today, AMAT popping higher, gaining over 4.5% today alone. Tesla moving higher, by almost 4%. Other speculative names are also moving higher, specifically the Chinese names, NIO, Xpeng, Alibaba, all moving higher. Yet the notable outperformance came from materials. We're talking about copper, Freeport-McMoRan gaining big today, steel, aluminum, even gold participated in the rally today in materials. Even fertilizers also moved higher, Mosaic, Nutrien all popped higher today. These are the kind of names that move higher when the dollar moves down, opening the gate for inflation to move higher. You see, under inflation, materials tend to outperform, historically speaking, but certain assets within materials need the dollar to go down to unlock that outperformance. One of them is copper. Look at the chart of Freeport-McMoRan, for example, a name that I own in my portfolio. It has been stagnant throughout last year, although inflation has been moving higher. Now that the dollar is moving down, all of a sudden copper is shooting up higher. On the other hand, look at aluminum or steel stocks. They outperformed in 2021, regardless of the dollar, because inflation was moving higher. So we know that copper has a high degree of sensitivity when it comes to the US dollar. It needs a weaker dollar to move higher. What about the ETF heat map? Muted action across the board, but we're seeing some gains in the inflationary side, the XOP, the XME, the high multiple corners. They're either muted or getting shot. Look at the performance of the XBI, the biotech ETF, the high multiples. That's getting shot over 3% today. What's floating technology, the NASDAQ, is the SOXL, the performance of chips. Look at the contrast between growth and value. Growth slightly outperforming value, but it's neck and neck. What does that say? If the market really felt that this is the peak of inflation, this CPI reading is the peak, then we should have seen bond yields moving down and growth outperforming value significantly. This is not the message from the stock market today, because growth and value neck to neck. Yields stayed flat. The dollar is the mystery here. Another notable action is the outperformance from emerging markets and international markets in general. Whether we're talking about European ETFs, the Brazilian ETF was hot today, gaining over 3%, the Japanese ETF, Chinese ETFs, the FXI, emerging markets, all of them moved higher. And this is yet again another indicator that we have a lookout for value, specifically from the institutional side. They're not finding value in US markets, so they're hunting for value overseas. Moving on to charts, starting with the SPY chart of the SPY. What's going on here? We had a gap higher. The shake it off. CPI is hotter. Who cares? Shake it off. And then we went down and consolidated for the rest of the day in what it appears to be a bear flag consolidation pattern. Now, the candlestick pattern is just one indicator. You have to combine that with the dollar, with the 10-year yield, with the VIX. You cannot just rely on candlestick patterns. But let's say the bear flag plays out, then we're looking down for 466.5 for support. Moving on to the daily chart for the continuous contract for the S&P 500. We are now trading above the bull to bear advantage line, which happens to be 4,657, which means that the bulls are in charge right now. The problem is we have negative divergences on both momentum indicators, be it the RSI or the MACD. We're also seeing higher than average volumes, be it on the selling side or the buying side. The risk for the bulls here is, what if this is a mere ABC pattern? We formed the A leg, the chart rebounded higher, forming the B leg, and now we're about to form the C leg. And if that happens, that could take us down all the way to 4,472. That will be a steep decline, and it will be a clear indicator that we already have a top in this market. What about the 30 minutes chart for the NASDAQ, the triple Qs? What's going on here? Again, gapping higher, but consolidating below the highs of the day in what it appears to be a bear flag pattern. If that plays out, we're looking down at 379 for support. But again, you got to remember this. The candlestick patterns is just one indicator. You have to look for the dollar, the 10-year yield, the VXN in this case. That will guide your trading. And I tweeted, by the way, that I've already closed my rebound plays because my thesis was a softer reading in the CPI, which will ignite a massive run in the Qs and the oversold names, the high-tech, high-multiple names. That is not happening, obviously, and therefore I dumped, and I'm awaiting a shorting opportunity once again. Now, here's the daily chart for the continuous contract for the NASDAQ. What's going on here? The chart peaked above 15,975, and it pulled back from that point on. The volume is surging higher on the selling and the buying sides. The momentum indicators remain in negative divergence. This is a win for the bears, and the risk for the bulls is, and perhaps what the bears are waiting for, what if this is, yet again, a formation of an ABC pattern? We formed the A leg. We are in the B leg. Once that tops out, we're going to flush down to form the C leg. And if that happens, we're looking down for 15,000. as the next support. Moving on to a 30-minute chart for the IWM, the Russell 2000. It looked good in the morning, popping higher, gapping higher above 218. That didn't last long, and the IWM closed pretty much at the lows of the day. And it appears that the bear flag is playing out in the IWM already. And if that happens, we're looking down for 211 for support. Dixie, the dollar index, what's going on here from a daily chart perspective? A decisive confirmation to the downside, once and for all, confirming that the dollar has lost 96 as support. This is good news for commodities, and therefore you're seeing oil moving higher, gas moving higher, metals moving higher, including the old man gold. Even gold is moving higher. And if it continues to move higher, we're waiting for the resistance of the three amigos around 1,835. And here it is, the daily chart, the 10-year yield. If the folks at CNBC and the Wall Street Journal and the likes are right that we're seeing the peak of inflation, and that is evident by the performance of the dollar, then why didn't the 10-year yield go down? It should have flushed down dramatically. We should have seen an insane rebound in the oversold, high multiple, tech, NASDAQ kind of names. We didn't see that. The 10-year is pretty much working out some overbought conditions. The RSI, the MACD, it pulled down by a little bit, and now it's moving higher. The risk here is, what if this is an ABC pattern? A positive one this time around. We formed the A leg, we are now forming the B leg, and perhaps the B leg will bottom at 1.7%, and then we see a bounce higher, forming the C leg, taking us all the way perhaps to 2%. And honestly, we have to start to watch the 2-year yield because it is more important than the 10-year yield. The 2-year is what the Fed controls, and the 2-year popped higher today, responding to the hot CPI reading. When the 2-year moves higher, it is a proxy indicator that the Fed's going to move interest rates higher. The higher the 2-year goes, the higher interest rate hike expectations will go. Moving on to the TLT weekly chart, what's going on here? Losing a bit of the luster, it already lost 149. The week is still young, we have 2 days to go, but it's hard to believe that the TLT will make a U-turn and recapture 149 as support. Not going to happen. So for now, the outlook remains the same. Yields higher, bond prices down. What about the VIX 4 hours chart? What's going on here? We have a crossing of the MACD indicator producing red impressions on the histogram. This is an indicator that the VIX has stopped for now and a green light for the SPY to move higher. We're below 20. All of these are good signs, by the way, for the SPY to move higher. But watch out because the VIX could pop higher again, and we could see green impressions of the MACD really fast. If that happens, then you know that the dip was transitory in the VIX, and we should fade the rip in the SPY and the rest of the market. What about a daily chart for Apple? What's going on here? Popping above the sloping line of resistance, now support. The problem with Apple is, what if this is a reverse ABC pattern? And if it is, we're going down, not just to close the gap at 165.32, but perhaps retest the upper line of the channel. Tesla, 30 minutes chart, what's going on here? It recaptured 1,090.5 for support. This is positive. It's a win for the bulls. The problem is, it happened without conviction. What am I talking about when I say conviction? I'm talking about the 10-year yield. It did not move down. That would have been a confirmation for the rally in Tesla. I'm talking about the lackluster activities in the options market. Had we seen a higher than average call options volume in Tesla, that could have been a confirmation for the rebound that we got today. Therefore, it is a positive development for the chart. The problem is, it is on shaky grounds. And no, I'm not talking about the shake it up kind of ground, the Taylor Swift ground. I'm talking about shaky legs. Moving on to tulips, BTC, what's going on here? Moving higher. So far, so good. We had some positive indicators yesterday. The volume moved higher on the buying side, so we have buyers. The momentum indicators also bottoming and curling upward. We are now trading above 42,000. All of these are good signs for BTC. The problem is, if the 10-year yield pops higher again and we go back to risk off, it's hard to see Bitcoin moving higher. And this is, by the way, a reflection of the contrast between the daily charts and the monthly charts. The daily, in the case of Bitcoin, might be positive right now. It might be turning the corner. But when you look at the monthly, the chart with the higher weighting, it's not looking good. It's a head and shoulder formation. It's about to cross the negative territory in the MACD. So what does that mean? You can buy the dip in Bitcoin, but keep that in your mind, that you're buying for a trade. You're buying at 42,000, for example. You flip it to 45, to 50, and you get out. You're not going to go to the moon again. It might do so years from now. In the meantime, it is going to the dumpster. You're going to visit the dumpster before you visit the moon. And lastly, what about AMC? What's going on here? No update. Still consolidating, waiting and waiting and waiting for buyers. It is asking, any buyers, any buyers, any buyers? If there are no buyers, the sellers will show up and we will have a short trade for AMC. Watch out for 21 for support. If that is violated, then we're going to have a short trade, perhaps all the way to 15, if not 10. But for now, we're going to keep an open mind that perhaps for whatever reason, the buyers will show up and they could conduct a rescue plan for AMC, pushing it higher, recapture 26 as support. It's a watch and see for now, not buying calls, not buying puts until one or two things happen. Number one, recapturing 26 as support. If that happens, I'm buying calls. Number two, violating 21 as support, and that will initiate the short trade, buying puts. Anyhow, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have initial jobless claims, but most importantly, the producer price index. If it comes out hot again, it will be a confirmation that the CPI did not peak because the PPI is a leading indicator for the upcoming CPI. And in my opinion, the PPI is more important to watch than the CPI. We also have some Fed zombies speaking tomorrow. How about Fed Governor Braindead, who's going to be confirmed to be the vice chair, replacing Clarida. We also have Barkin and Evans from Chicago. And we are assuming that both of them will take their dove wings off and replace them with the hawk wings. They're all becoming hawks all of a sudden. These people have no loyalty at all. You cannot trust them one way or the other. If you are one of those blind bulls, the Fed got us. The Fed got our back. Yeah, they got your back with one hand, yet they have a sharp knife with the other, and they're ready to stab. Anyhow, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow.